There was a lot of chatter last week about IEA's new forecast where they brought their business as usual, or as they call it, current stated policy scenario back. That scenario essentially sees oil demand continuing to grow well through 2050. But honestly, as a client told me last week, oil companies aren't really waiting on these scenarios or outlooks to decide where they want to drill or deploy new capital. But I think the part that didn't get enough attention was the fact that IEA also raised its estimate for the oil surplus next year, a record 4 million barrels per day, more than demand in 2026. So that's nearly 3.5 to 4% of oil demand in 2026, which is a fairly significant number. OPEC also issued its industry outlook recently, and now they are also showing a surplus in 2026 after projecting a balanced market for quite a while this year. So this coupled with the broader economic concerns has been impacting oil prices. WTI has fallen from as much as $80 this year to about $60 this week. But we at ADI worry that oil prices could fall even further. And why do we think that? First, global economic growth is slowing. There are multiple indicators that suggest that GDP projections for next year have been weaker, around 3 to a little over 3.25%. Manufacturing activity has significantly slowed down. Trade volumes have declined. Consumer spending behavior has been extremely cautious, and central banks have been cutting back on rates. And then across the board, we are seeing unemployment rising. And then, of course, there's also the broader geopolitical tensions and high debt levels that we are seeing across economies around the world. So this economic slowdown is going to have an impact on oil demand. Second, oil prices have been propped up by China because of the buying that they have been doing this quarter and are expected to do next year, almost 800,000 barrels per day of oil through this quarter and next quarter, primarily because China is using this oil to fill their strategic reserves. Because of this demand, it has put a little bit of a floor on oil prices in this market. And we see similar support on the demand side from India as well, which has been flipping over from buying their oil from Russia to sourcing oil from other sources. And that's created some incremental demand in the market. So if China starts slowing down its buying or tapers off of its buying spree at the end of the first quarter, and as the global economy starts slowing down, let's say in 2026, the IEA could be right about its high forecast around 4 million barrels per day of surplus, and that'll mean that oil prices could fall more than what we have seen so far. Stay tuned to ADI and join us at the ADI Forum in January in Houston. You can sign up at adi-forum.com.